Biomian Limited is a Mumbai-based biotech company with common stock and listed futures options on the National Stock Exchange. The Viswan family office currently owns 10,000 Biomian common shares. VFO would like to reduce its long Biomian position and diversify its equity market exposure, but will delay a cash sale of shares for tax reasons for 6 months. Which of the following derivative contracts available to VFO's Chief Investment Officer is best suited to reduce exposure to a decline in Biomian stock price in the next 6 months? A is a short put position on Biomian stock that expires in 6 months. So here's what a short put position entails. Since we're selling, we're going to get a premium, and as the price of the stock falls, we would actually lose money on a short put position. Since we're trying to protect the value of our position, the position is going to drop in value. If the price drops in value, we want a derivative that actually increases in value as the price drops, not decreases. We can get rid of A. A long call position on Biomian stock that expires in 6 months. Well, where's our gain happening? Our gain is happening as the price increases, but as the price drops, we'll lose money on the price of the call because it's going to drop below the strike. We want to be up in this region somewhere here. We note that we are down here. We have to get rid of that one. And a short futures position. You'll recall a long futures position had a linear payoff. As the price of the underlying increased, the value of the contract increased. Well, a short position would just be the opposite. So as the price drops, look what happens. These are gains, these are losses. Is the short contract gains? We want to be in this top quadrant here. That's where we are. C. VFO's market strategist believes that Biomian's share price will rise over the next 6 months, but would like to protect against a decline in Biomian's share price over that period. Which of the following positions is best suited for VFO to manage its existing Biomian exposure based on this view? So we want to be in the area of positive payoffs as the price drops, which means if this is the underlying as the price drops, we want to be somewhere up here. A long put position on Biomian stock that expires in 6 months. Well, for a long put position, we're going to pay the premium because we're buying it. And as the price drops, here's what happens. Well, that is the profile we want. A short call position on Biomian stock that expires in 6 months. Well, here we're going to be getting the premium. We're going to be getting the call. Now, you may say we're in the area of gains. That would work as well, right? We believe the share price will rise. We're just trying to protect against a decline. Here, we would be giving away all the gains because as the price increases, we would start to lose money. We certainly don't want this going on, and we don't want this limitedness here. We would like to continue to profit as it goes up, and certainly as the as it goes down. And if the price goes up, well, we only paid so much for it. We can't continue to lose. So we can get rid of that one. A long futures position in Biomian stock that settles in 6 months. And as the price drops, what's going to happen? We lose money. Our losses are in this area of the chart. We wanted something that increased in payoff as the price dropped. The only one that does that is A. Assume that Biomian shares rise over the next 6 months. Which of the following statements about VFO's derivative strategies under this scenario is most accurate? A forward sale of Biomian shares in 6 months. We have a forward sale, so we know we're dealing with a forward contract. It's a sale, so it's a short forward. This line right here is the payoff of a short forward. A short forward, a forward sale of Biomian shares in 6 months would be more profitable than purchasing the right to sell Biomian shares in 6 months. Well, purchasing the right, that is a long put. And of course, we pay the put premium to get that done, and as the price falls, there is the payoff. And we're assuming that shares went up over the next 6 months. Which is more profitable? Well, it depends on where the price went. Up to a certain point, the forward is more profitable than the option. But after a certain point of the price rising, the option is more profitable than the forward. It just said assume shares rise over the next 6 months. I can't tell the difference. B is just the opposite. Purchasing the right to sell Biomian shares, the long put, would be more profitable than a forward sale in 6 months. Well, it depends on where we are. If we denote this point as the break-even point between the two, or the indifference point between the two, anything above that, we prefer the option. Anything above the strike price to the break-even point, we prefer the forward. So we're in the same position as, well, without knowing how much the price went up, without knowing some numbers, what was the strike price, what was the forward price, what was the price of the option, all of that, it's kind of hard to tell. We do not have enough information to determine whether forward sale or the right to sell Biomian shares would be more profitable, and we don't. VFO's market strategist is considering a 6-month call option strategy on the Nifty 50 benchmark Indian stock market index to increase broad market equity exposure. The Nifty 50 price today is 15,200, and the strategist observes that a call option with a 16,000 exercise price is trading at a premium of 1,500. That means the call, C naught, is 1,500. Which of the following represents the payoff and profit of this strategy just prior to maturity if the Nifty 50 is trading at 16,500? So 16,500 minus, what was our strike price? 16,000 is 500. So there's a payoff of 500 right there. However, it cost us 1,500 to get that done, so our profit is negative 1,000. So let's look for a 500 payoff. Well, look at these payoffs at 1,300. You can get rid of it. There's only one that we have. And of course, our loss is 1,000. There's our profit, negative 1,000. A